All right. Good afternoon. We will go ahead and get this started. I am Stephanie Anderson, certified wealth strategist with Pulse Financial Services, and I'm here to give you a very brief update on our views on the economic and market outlook using slides from our third quarter JP Morgan Guide to the Market. We have 10 points in 10 slides, and hopefully it'll take about 10 minutes. The collective impact of tariffs and tariff uncertainty, federal government cutbacks, and declining immigration and tourism appear to be slowing the U.S. economy. Looking past swings in imports and inventories, we expect real final sales of domestic product to slide from 2% annualized growth in the first quarter to 0.2% in the second quarter to a negative reading in the third. However, passage of the Reconciliation Act or bill should inject stimulus into the economy, both through lower income tax withholding from the third quarter on, and more powerfully via very strong income tax refunds in 2026. This should boost economic activity in the first half of 2026. However, we expect growth to slow again in the second half of 2026 as the refund effect fades and the effects of higher tariffs and lower immigration linger. A slower growing U.S. economy will mean slower job growth, with average monthly payroll gains likely falling below 100,000 for the rest of 2025 before reaccelerating slightly in 2026. However, the impact of this slow job growth on the unemployment rate should be suppressed by a sharp decline in immigration. The administration has succeeded in reducing illegal immigration to almost zero and has been ramping up its deportation efforts. However, we are also seeing a significant decline in the issuance of new immigrant visas at foreign embassies. Putting it all together suggests that net immigration could fall to less than 250,000 per year, down from an average of over 1 million per year in the 20 years before the pandemic. This implies a declining labor force, limiting the increase in the unemployment rate to just 4.5% by the fourth quarter of this year. We do expect that wage growth will remain steady as recession worries counteract tight labor markets in wage negotiations. So far, the impact on tariffs on inflation appears to be minor, with year-over-year CPI inflation coming in at just 2.4% in May. However, we believe that the inflationary impacts of tariffs have been delayed, not canceled, and as retailers apply markups to new inventories, consumer prices should see some significant increases. The numbers from June just came out yesterday, which show CPI at 2.7% year over year, which lends to this idea. By the fourth quarter, we expect inflation will have risen to 3.5% year over year, according to the Consumer Price Index, and about 3% according to the Personal Consumption Deflator, which is the Fed's preferred measure. This inflation could be sustained into early 2026 due to the impacts of higher income tax refunds on consumer spending. However, as the economy slows again in the second half of 2026, inflation should gradually return to the Fed's 2% target. After cutting rates by 1% in the second half of last year, the Federal Reserve has maintained the federal funds rate in a range of 4.25% to 4.5% throughout the first half of 2025. We expect them to remain on hold at least over the next few months and perhaps deliver just 1.25% rate cut by the end of the year for two key reasons. First, there remains very significant uncertainty on the final shape of federal government policies on tariffs, immigration, and the budget, and the impact of all of these policies on inflation over the rest of 2025 and 2026. Second, according to their summary of economic projections, by the end of 2025, they expect the inflation rate to be further above their 2% target than the unemployment will be relative to its 4.2% long-run expectation. In this scenario, it is hard to justify aggressive Fed easing. We do expect, however, that the Fed could cut more if the economy slows again in the second half of 2026. One glaring anomaly at the start of this year was the huge outperformance of the largest companies in the S&P 500, both in terms of earnings and equity market gains. Much of this reflects the dominant market position of US tech firms and a surge of interest in the investment spending on artificial intelligence. That being said, in recent years, the stock market performance of these companies had generally outpaced their performance in earnings, leaving their valuations at generally very high levels relative to the rest of the market. Despite huge market volatility during the second quarter, this anomaly persists today, with the top 10 companies in the S&P 500 representing well over 35% of the market value for the entire index. For long-term investors, it may make sense to increase allocations to other areas of financial markets in case economic, geopolitical, or idiosyncratic forces turns a mega cap US equity boom into a bust. A lack of Fed easing, the prospect of higher inflation, and the likelihood of fiscal stimulus have all put a floor under long-term interest rates in 2025, despite increasing signs of a slower economy. We expect long-term rates to remain range-bound as the effects of a continued economic slowdown are counteracted by increased Treasury issuance in the wake of the passage of the reconciliation bill and an associated increase in the debt ceiling. For investors, there's not a strong argument for making a bet either on duration or credit in bonds. Even if the economy eventually weakens, any rally in the bonds should be limited by rising federal borrowing and stubborn inflation. Moreover, at least in the short run, we expect the economy to avoid a recession, partially justifying today's tight credit spreads. However, we do think that roughly normal bond allocations make sense in this environment. Historically, today's close to 5% yield on the Bloomberg Bond Index has been associated with close to 5% annual returns over a 5-year period. Provided inflation fades late next year, these yields and potential returns seem reasonable. The dollar has fallen sharply since the start of this year. This may in part reflect its high valuation going into the year and America's chronic trade deficits. However, it could also be the result of questions among both US and international investors about their concentration in US assets and the policies of the new US administration. A key driver of the dollar in the long run has been the higher interest rates offered on US debt compared to other developing market economies. In the short run, with the European Central Bank in particular seeming more willing to cut than the Federal Reserve, this interest rate gap could be maintained, limiting further US dollar decline. However, we still believe that in the long run, a downshift in US economic growth combined with a still high trade deficit should lead to a dollar decline. The first half of 2025 has seen international stocks outperform their US counterparts by a wide margin, as local currency outperformance has been amplified by the impact of a falling dollar. Given this dramatic outperformance, many investors may be wondering if they have missed the boat in increasing international allocations. We don't believe so for 3 reasons. First, we show in the chart, even after a 2025 rally, non-US stocks still carry much lower valuations than their US counterparts. Second, the dollar remains very overvalued given our trade fundamentals, and we expect it to fall in the years to come. Third, given the outperformance of US stocks over the last decade, most US investors are likely very underweight in international stocks relative to an appropriate long-term asset allocation. The last few years have seen very strong stock market gains. However, that performance could limit future returns. Moreover, the traditional role that bonds play in zagging when stocks zig has been challenged in recent years by higher inflation, which negatively impacts both stocks and bonds. In this environment, many investors are exploring alternative assets such as private equity, private credit, infrastructure, and real estate. These assets are all quite different. Some provide strong long-run returns, some generate strong current income, and some act as a good diversifier to publicly traded stocks and bonds. Many of them are illiquid and so should be thought of only as long-term investments, and the performance of different assets within the alternative space has varied considerably depending on the manager. Still, adding alternatives to a traditional stock bond portfolio may make sense for many investors, and we expect this area of financial markets to continue to grow in the years ahead. Finally, we always consider not just economic fundamentals and valuations, but how investors are positioned. The last 5 or 6 years, while filled with dramatic and difficult national and global events, have also, on balance, seen very strong investment gains. However, these gains have been by no means even, and if investors have not been disciplined in rebalancing their portfolios, they have not just grown in recent years, they have grown more risky. Indeed, as we show in this chart, a portfolio which was 60% invested in stocks and 40% invested in bonds at the start of 2019 would today have over a 70% allocation to stocks, assuming that the dividends were reinvested in stocks and coupons in bonds over the intervening years. This may not be appropriate given gains in wealth, but also uncertainties in the outlook. For many investors, as we enter the second half of 2025, it may make sense to gradually rebalance and add diversification to a portfolio, particularly if this can be done in a tax-efficient manner. I'm going to go ahead and go through our disclosures here and really just wrap up by letting everybody know that we are here for you and happy to answer any questions. If you want to shoot us an email or give us a call at any point in time or schedule a review to take a look at your personal portfolio. We do have rebalancing automatically happening, usually on an annual basis. So we're in good shape on that front, but certainly as things change, as risk tolerances change or time horizons change, we always want to be having those conversations with you folks and making sure that we're making appropriate updates. Thank you so much for your time today. We greatly appreciate it, and we hope you have found some insight from our guide to the markets. Have a wonderful afternoon. Thank you.